in anyone's portfolio, they need real estate as an asset.
I'm very, very excited to be here with Jeff, the CEO at Buckingham Luxury Vacation Rentals. He's a serial entrepreneur, 17 years in investment banking, 40 reverse merger transaction, profit and non-profit organizations, continues to innovate on the AI and technology. A lot to unpack here.
We went from 7,500 full-time residents to 15,000 and decided it was time to move to a little ranch community around the corner.
What is the biggest misconception that people have about the impact that AI will have?
The myth associated with AI is that people are going to lose jobs.
What do you think has been the most valuable lesson that you have gotten from a particular mistake that you've made throughout your career?
My perspective is cash is king. Cash is always king. Cash allows you to buy additional properties. Cash allows you to have a better lifestyle at the end of the day. And the same argument could be made against short-term vacation rentals as an asset class. We're in a downturn right now. We've seen it in our per property returns. And so people right now need to be patient.
The challenge of leverage within the vacation rental space versus the leverage that's available in commercial real estate, does that make this an industry where it's harder to build wealth? Hello, everyone, and welcome to the Hospitality Edge podcast, where we bring together what we think are two sides of the same coin, real estate and hospitality, and where we have as an objective to bring here entrepreneurs, leaders, visionary operators, as well as founders, so they can tell us about their stories, their journeys, and the lessons that they have learned along the way. But more importantly, what are some of the mistakes as well, perhaps, that we can avoid making ourselves by learning from their experiences. So today, I'm very, very excited to be here with Jeff. Jeff, he's the CEO at Buckingham Luxury Vacation Rentals. He's a serial entrepreneur. He has a career where he has, basically been working on entrepreneurial projects since he was 16 years old. Many years, 17 years as well in investment banking and financial consulting. He's participated in more than 40, reverse merger transactions. So a lot of, finance, M&A background as well as, currently, heavily involved in, several boards for profit and non-profit organizations. As well as continues to innovate on the AI and technology side of things, both for this industry and other industries. So a lot to try to unpack here and cover. But before we get started to try to do that, Jeff, thank you so much for being here today. Where are you taking the call from?
Yes, Sebastian, thank you for having me. I'm taking the call from my home in Camas, Utah, my home office, just outside of Park City. We were in Park City for a lot of years, and then post-COVID, our town changed a whole bunch. We went from 7,500 full-time residents to 15,000 and decided it was time to move to a little ranch community around the corner.
That's amazing. That's amazing. So Jeff, I'll start right on by asking you, about AI, because it's a hot topic and it's something you're, heavily involved in. So before we go into your story and the timeline of it all, what is the biggest misconception that people have about the impact that AI will have on the vacation rental industry? And how do you distinguish what is true and not true as far as, how much of an impact AI will have in our space?
So I am very involved in AI with a company called Simple Acceleration Systems and a tool called Goldmine AI System. And what I would say the biggest thing that's going to happen with AI, we are going to see AI revolutionize the way that we communicate with guests and the way that we're able to provide a higher level of customer service. The myth associated with AI is that people are going to lose jobs as a result of that. I don't think that that's the case. I believe that AI will just enhance the jobs that are being done and make them much better so that people are, businesses will run smoother, guests will have a better experience, and the services that can be provided by AI is just astounding today. So we're using it for sales and marketing to start with, lead generation, lead management, closing leads, both on the guest and on the homeowner side. And AI is a very powerful tool there because it can pull data that you and I can't pull. And from there, the minute they book, we have a assistant. It's basically a virtual concierge that will begin reaching out to those guests the second they booked. It will introduce it as, I'm Jane. I'm the assistant for Buckingham Tahoe Rentals, and I'm here to help you with everything you might need during your trip, whether it be a reservation at a restaurant, what's happening in town, getting you the information on, things that we typically had apps for that they may or may not plug into. Now they're just going to have it right there. If they've got a question with the home, if they have a question with how the HVAC system runs, what's the internet password, all the things that we're dealing with in a customer service perspective, AI is going to solve that for us. And it's going to do it in a way that is seamless, and it's just going to happen. And then if it needs to escalate, all of the notes related to AI, what's happening with that consumer communication, we even biometrically can determine if the guest is getting frustrated based upon their responses, their timely responses, what they're saying in their words. And we can then escalate it to an actual customer service agent if we need to. So we think that those types of tools are just going to enhance what we're doing as an industry and make us much better.
When it comes to everything we've spoken about prior to this call, I want to give people something very valuable right away, and that is, you've spoken about, the many learnings that you've had along the way, and in some cases some of those learnings have come from mistakes and errors, and of course that led to a lot of successes as well. But if you look back at your career, and specifically for property management companies or operators in the vacation rental industry listening to this, what do you think has been the most valuable lesson that you have gotten from a particular mistake that you've made throughout your career?
People mistakes are very expensive. They're learning lessons, yes, but the whole process of integrating people, we use a process that was written in a book by Vern Harnish called Scaling Up. And scaling up leads to a one-page strategic plan. And one part of that whole journey is the ideal team player. It's a book that's written by Patrick Lencioni. And I would say that the biggest mistake that I've made in my career is related to people not being ideal team players. And so I think that book is an absolute gem for everyone, because if you identify those flaws early on, which you will, reading that book, you'll know immediately, where they fit as an ideal team player. You can avoid a lot of the mistakes that I've made, because even though I had that book and I had that tool related to people, I still didn't read it like it was a Bible. And I think that is something that you have to do, have to discipline, despite their success in the past or their story or what they're telling you. You have to have the discipline to know when they are not an ideal team player and that they do not fit, no matter their success. The guy that I brought in built a company from literally 400,000 a month to 400 million a year. But he was not an ideal team player. And at the end of the day, it cost me a bankruptcy. And I was off raising capital, making acquisitions, doing the business. and he is my president, did not have our ideal team player principles guiding him. And as a result, he took the company down a path. He hired too many people. Our overhead got too high. And that was all during COVID. So when things were booming and then they came back to normal, and I didn't course correct quickly enough, it took me 6 months and it cost me bankruptcy and a very hard lesson.
Wow. And from your experience as well, and also, of course, touching on the principles of this book, is an ideal team player something that is standardized, across companies and industries and sectors, or is it something that's going to change, dramatically from one culture, one industry, one company to another?
I think that the underlying principle is humble, hungry, smart people. And you can have two of the three, but if you don't have humble, you've got the wrong person and you need to replace them. And it doesn't matter what role they play in your company. If they're not humble, you can't correct that. And they will do things that are detrimental to your culture, to your financial picture. They'll make decisions. They're ego-based decisions. They're not team-based decisions. And so I think it applies to any company, any industry. And the whole scaling up process gives companies a one-page strategic plan that they can then work off of. You create your big rocks, you create reporting systems inside of that. There's a whole process of the one-page strategic plan. It takes about a day and a half to 2 days with a coach to go through and set that up. If you're doing it on your own, it's going to take you a little bit longer than that. But that's how I scale businesses, whether they're in this industry or defense or AI technologies. I mean, it's something that I implement at every company that I'm involved in.
And just to confirm, it's humble, hungry, and what's the third one? Is it competent or?
Humble, hungry, and smart with people. Sometimes you can have two of the three and you can be okay. But as you read the book, you'll get into the details of it and how it really applies in organization and in your culture. And what happens with scaling up and a one-page strategic plan is everybody gets on the same oars and everybody's pulling for the same goal. And then they're reporting weekly, monthly, quarterly, annually on everything that they're dealing with. So their successes, their challenges, and their failures, or where they're not meeting the bar. They set up their own parameters related to that reporting, and it all flows up to the leader of the company. And so, I think that is just something that every company that hasn't employed that type of process for building their business should, because it will give you long-term direction. And it also gives you a path that if you get hit by a truck tomorrow and you're the leader of that company, someone else can step in your shoes. If you haven't done that work, then if you get hit by a truck tomorrow, then the company goes away with you, because it's all in here and it's not a one strategic plan where other people can pick it up and run.
Wow. And what do you think was the insight or the piece of context that you gained from having realized that even though you had read that book, that you had still brought in someone that didn't necessarily meet all of those three traits and characteristics? Is it something that you could have spotted earlier on by being more conscious about those principles that you were trying to recruit based on, or maybe you were not seeing it as a Bible like you were saying earlier, and you just kind of saw the red flags but decided to ignore them? What was your input there?
I had other red flags. He was not humble. He was not smart with people. And I chose to ignore it because of his past set. And at the end of the day, it led to the crash of the company. So I would say that my insight is you absolutely have to have the discipline, no matter who they are, to stick to your guns related to the ideal team player.
And in your experience as a leader, do you think that this is something that can be trained or coached, where you might have someone that lacks, one of these traits but has all the intentions to get better? Have you seen that work, or is it the type of thing where it's kind of your personality, and it's hard to change someone's personality?
As you read the book, there is one that can be fixed and there's one that cannot. It is possible to coach people through it. And at the same time, there's one of those three that you can't change, the way that someone is. And I thought that I might be able to influence him because I'm a leader. And so I thought that I might be able to influence him to get in line. And at the end of the day, it was I say.
And I don't know, just guessing here, but must be the humbleness one that must be, more difficult to change.
Into the book. You got it.
Gotta read it. Yeah, no, definitely. You gotta read it. Okay, makes sense.
Well, the secrets. I'm encouraging people to pick up the book, get scaling up, implement it in your company, use the ideal team player. You're going to have to replace some people. There's no doubt in my mind. But at the end of it, you'll have a stronger company with a better culture and better chance to succeed.
That's amazing. Thanks for the book recommendation. Sounds like a great one. Now let's talk a little bit about, okay, got it. That's the main lesson. Let's now get into the actual timeline of it all. So, when did you start your first business, and what's been the very high level summary of the timeline of your career? And then we'll dig into certain aspects of that experience to try to extract the lessons that you've learned along the way.
So my first business was in lawn care and landscaping. I was a teenager. So this is back in the mid 80s. I'm 54 years old. I have young children, but I'm not a young man. And I was part of the era of the first generation of cell phones. I had them in my trucks. I carried around the original Motorola brick, which was like this big of a phone, but it was super powerful because it allowed me from class in high school to run teams that were out doing lawn care and landscaping work, and started there, and was really fortunate after that. I joined my father at the company that he had. My father's a corporate finance expert, and actually he and an attorney from Reno created the 504 exemption. So they've been in the capital markets. My dad's been in the capital markets since 1970 when he started his first brokerage firm, and got out of the brokerage business late 70s, early 80s, and started doing reverse mergers, what are known today as SPACs. And so we would do a reverse merger into a public shell corporation with a concurrent financing or a PIPE. And so I involved in a company that he'd taken public and started as a VP, young, out of college, lots of enthusiasm, built the company out, made an acquisition. Within 2 years, I was the president of that company. We got rid of it. And as a result of that, I joined my dad in the investment business, which was, a super fortunate thing for me because I was able to come under the wings of my father and his knowledge and his contacts and put my energy behind it. And we exploded our investment banking business. I think I've taken close. It's over 50 now, private companies, public. Two of them today are on the New York Stock Exchange, Northern Oil and Gas. I was the former president. If you go back to the pre-Northern Oil and Gas 8K days, you'll see my name on there, signing those documents as a public company. Obviously discovered the Bakken, and we owned an interest in 85% of the wells in the Bakken. And then we did another deal that was called Gasco, the Tennessee Gas Company. It today is Riley Exploration, Riley Petroleum in Houston, Texas. Along the way, we also had Miller Energy, which is since gone bankrupt, is the founder of that company died, and he didn't have a one-page strategic plan and a stepping up, plan in place. So nobody took it over, but they own Prudhoe Bay in Alaska. So at one point we had three of the largest independent oil and gas companies in America operating in Texas, operating in the Bakken, and they own Prudhoe Bay in Alaska. So we had three of the larger independent fields through companies that we took public. Along the way, we financed those companies that we took public to the tune of like $1 billion. And so we raised a lot of capital, got into vacation rentals after the great financial recession in 2008. And so we started in 2011 in Park City, Utah, with a focus on high-end luxury. And along the way, I started several other businesses. So I was in the solar sector, solar. We grew that company to $1.2 billion in backlog with $100 million in revenue before it went away. And then I did Proactive, which is the skincare product. I put it on all of the shopping mall carts in America. Grew that business from $500 million in sales with infomercials to $1.2 billion. I was eventually bought by Nestle. And was bought out along the way, so I didn't get to participate in that monster upside that the partner did. And as you mentioned, big involved in AI, obviously have Buckingham, and then I'm building a health and wellness company too. So I am literally this serial entrepreneur. I am ADD, ADHD, which allows me to do one or two things well. When I get free, I get scattered a bit. But that's kind of my world today.
Wow. And there's a lot there. So one of the things I want to understand is, how you get into vacation rentals, and what did your background in finance and corporate finance, capital markets, gave you as far as a unique perspective through which you see that industry, or saw that industry of vacation rentals at first, when you decided that it was something you wanted to be a part of?
You bet. So in 2008, when everything kind of crashed, I thought for 12 to 24 months it would come back. The regulatory pendulum swung in place after that. And as you may or may not remember, there was a ton of regulation that came on the financial sector. And so in 2010, I realized that it was not coming back. And my claim to fame in that whole corporate finance world with own more public shell corporations than anyone else in North America at one point. I think I had 26 public companies that I owned. And we were looking to do deals with all of those. And so I did a deal in a down market with a company that had 8 or 10 vacation rentals in Scottsdale, Arizona. We got involved in it. It was with a billionaire's son, and he turned out kind of be the black sheep. So everything they told us on the front end as we got into auditing financials was not true. We had to unring the transaction. But at the same time, I liked the space enough that I said, okay, this is, when you get into a tough market and a tough business environment, like we were in post the great financial recession, you look for weaknesses in the wall, right? We were pushing and pushing and pushing and trying to figure out, where there was a weakness. And we found it in vacation rentals, because you had all these high-end, speculators that had bought or built second homes as specs, and all of a sudden get into a great financial recession, and now they're not able to make their mortgage payments, for losing their homes. And so both on Park City high-end luxury and helping homeowners save their homes. That was our pitch. Our pitch was, look, you're sitting on a house, it's a $2 million today 10, but a $2 million home that you're not able to pay for. And we believe that if we come in and put vacation rentals on it, we can generate $200,000 to $300,000 a year in revenue and save your property, save your property. And we did. And so that's how we got started in vacation rentals, was during that period of challenge where people were just, at risk of losing. And so we came in and solved a problem, and then, you know, got to really like the industry. What I would say is the pairing component of corporate finance and what we were able to do in vacation rentals. I've done deals where we're raising $1 to $28 million. And so numbers don't scare me. What I found is that is intimidating for great salespeople. So what we learned is that a great salesperson in some other industry may struggle in our industry as a result of just the dollar number associated with these properties. So they get intimidated by a house that's 2 to 5 million, where, myself and others that have succeeded on the biz dev side don't get intimidated at all. I trained nearly 40 people on business development, and out of the 40, I got one, maybe two to do it. And the other two I got through acquisition. And so, we spent a lot of time, effort, energy, built a training program, brought them in. And these are top real estate agents and top sales and marketing guys with, other firms. And we just couldn't see them gain traction in terms of business development. So I think that was our biggest challenge to growth. But the determining factor for me in making it work was there was no fear talking to someone about a $3 to $5 million house and coming into a rental collection.
And just to make sure I'm getting this, understanding this correctly, so when you first get involved in the vacation rental industry, did you start by acquiring these assets and these properties, or when you're talking about sales here, you're talking about sales for the management services that were being offered to homeowners?
Yeah. Yeah. So that's where we focused, was on the sales component related to managing all properties. And we acquired properties along the way because that's a natural part of this business. So I acquired one that was a B&B, converted it from a B&B into a single family vacation rental, and had 10 bedrooms and slept 28 in beds. We paid $1.3 million. We sold it for 3.5. 5 years later, and we produce $300,000 or $400,000 a year in income off of $1.375 million property. So returns were just sick on that one. Today, that property's worth, $8 to $10 million. So I wish that I probably would have kept it. My money would have been better spent there. We couldn't see that real estate was going to do what it did during COVID.
Yeah, it's we don't have that crystal ball. We wish we did. Now, when you look at this industry from an outsider's point of view, an outsider's that had seen a lot of business, success, and to the level of taking companies public, what is it about the business model of property management in the vacation rental space, when you look at the fundamentals of that business model, that made you think this was worth your time, or this was where you wanted to spend time on building that next venture? Because you might argue, or some people might argue, that it's very hard to scale, and that the operational aspect of the sector makes it a very challenging business to scale, or eventually take public. And even those that have managed to take this kind of business public, we've seen that it hasn't necessarily played out the way they were hoping to. So what were your thoughts on that, and how has your view on the business model of property management in the vacation rental space evolved since then?
What attracted me to the business is the ability to create that higher level guest experience at those luxury homes. And so that is the big one for me. And if I were to go back and do it again, I would probably just build a company around luxury, because it's the same amount of work to work with $1,000 a night client as it is to work with a $10,000 a night client. Obviously, you make 3 to 3.5 times the money in that bigger reservation, but I got homes that go up to 15,000 a night that we've managed and worked with, and I booked one for this Christmas this year. So I would say that that higher end luxury component attracted me, and the real estate component attracted me because my family's wealth is in real estate. We're mainly commercial, net, triple net, strip malls, and warehouse buildings and that type of stuff. And that's where my dad put all of his retirement eggs. But at the same time, you can generate a significantly higher return with this category and class of real estate. I've actually written a book on it. That's Your Path to Vacation Rentals Through the Vacation Rental Lifestyle, or with the Vacation Rental Lifestyle. And I think that is super attractive, to me. And I've done this. And so having homes in Hawaii and being able to live in Hawaii and in Park City and in Palm Springs, California, and, Austin, Texas, and just travel among those homes there's no better lifestyle, especially with young kids. When my kids were young, we used to spend 6 months a year in Hawaii and Maui, and it was freaking awesome. It's a great place to raise your kids. And, with homeschooling the way that it is today and what was caused by COVID and having to homeschool our kids, I think that freedom is there and available for any family that wants to pursue the vacation rental lifestyle. So for me, that's super powerful. I think my book publishes this week on Amazon, and that will be the second in a series on financial freedom. And so, that's what drew me to the sector. Now, what do you want to ask the next question about what I don't like about the sector? So
Go
you
for
go
it.
right
Go
ahead,
for it.
Sebastian.
Yeah, go for it. Go for it.
Okay, so challenges with the sector. Obviously, it's a very high touch industry that requires a lot of hand holding of both homeowners and of guests, and it's a high touch, high commitment level to provide that level of service. But I think the toughest part in the industry is the margins, because the hospitality margins is the margins in the hospitality sector, I should say, they're plagued. They're low margins, and so and that's actually what excites me about some other business that I'm involved in right now, because I'm dealing with 50% margins in the health and wellness business, and I'm dealing with 80% margins in the technology AI business. And so, I think that you have to have the vacation rental lifestyle component in it as an owner and a builder of one of these organizations in order to, that's what I did it for. I did it for the first, I built, my kids are only 10 and 12. So I built for basically 12 years a lifestyle business where we travel to second homes and we are able to vacation in those second homes, and it's a great lifestyle. It's a great way to raise your kids, and it's a great way for them to experience the world as well.
That's interesting. Now, when it comes to this theme of basically financial freedom, that was your first book, and then now more so it seems like on the lifestyle of vacation rentals, also related to financial freedom. I'm curious to know, because you mentioned that vacation rentals um, offered returns that were higher than any other asset class. Uh, it's something that you mentioned last time we spoke, and I'm curious to know if you see, vacation rentals as an asset class versus, let's say, commercial real estate as the best vehicle to build that wealth and that, financial freedom, versus the best vehicle to sort of, in a way, start getting more liquidity and more cash flow out of, wealth you might have created through other vehicles. In a sense, what I'm trying to, get to is the challenge of leverage within the vacation rental space versus the leverage, that's available in, commercial real estate. Does that make this an industry where it's harder to build wealth, and more of an industry where you can, once you have wealth, get more cash flow from your assets and, benefit from the lifestyle component? Or, you think that, you know leverage is something that will continue to get more favorable for vacation rentals, and that because of the cash flow in and of itself, it does allow you to, scale and build, if you're starting from, not having that cushion of wealth.
You bet. So I think that, let's talk about asset classes first. So I think that in anyone's portfolio, they need real estate as an asset beyond their home, because your home is not a cash flowing machine, right? It's somewhere you live and you have to have it. So um, the way that I view it is that vacation rental homes are the highest return in the sector of real estate on an asset. And so you know and we build pro formas and we model all this cash flow out in every real estate transaction that we do for ourselves. We also help our clients do that too. So if they're looking at a purchase, we'll put together a model for them that's a asset investment type model for buying that home, that shows at the end of the day what their net cash flows can be pre-tax and post-tax. And so real estate is a great way to shelter income because of the tax benefits of owning real estate. And I think that will forever be true. And so what I would say is that the next conversation that I would like to talk about is leveraging lease arbitrage to gain the capital in order to buy your first vacation rental property. And I've seen a lot of people do this. I've done it myself. It works very well. You have to be cognizant of the risks and the competition, and you have to make sure that your property is not a me too. Because if it's a me too property, you will barely make the payments related to your lease, and it will not gin the 3 or 4 times the lease amount, so that you can build that nest egg to go buy your first property. But let's talk about it for a minute. So if you've got $200,000 cash and you're looking to go buy a $500,000 property, those are kind of numbers that make sense. It makes sense to the bank. And so if you look at one property and what it's going to return you, doing that financial model and forecasting that I just described, you can come up with a number that at the end of the day is your pre and post tax return. And what you can do with that same $200,000 in a lease arbitrage scenario is you can find a furnished home that someone is looking to lease for, $2,000 to $5,000 a month. And you can go in there and, if you have to furnish it, obviously that chews up a bunch of your capital. So I wouldn't suggest that. But then you make that property shine. You put it, you make sure it's in a vacation rental friendly zone. You go to the homeowner and say, okay, we're going to lease this property from you and we're going to sublet it. So you want the permissions in your lease agreement to do that. But you can go in for, let's say it's a $5,000 a month lease. So your first and last is 10 grand. plus the first month's rent is $5,000. You might have to spend another $5,000 to spiff up that property, to furnish the kitchen, to put good linens on it. It might be a little bit more than that, but somewhere between 5 and 10,000. So now to lease that property and put it into your collection to start generating cash flow just costs you $20,000. Well, you can do that with 10 homes with that same $200,000 that you were just going to spend on one home. And so I always will encourage people, it depends on your goals. If you just want to own one property and you want it to be fairly simple and you're happy with a 10% net cash flow return pre-tax, then buying one property is fine. But if you want to take that, so let's say a $500,000 property, you're going to earn $50,000. Well, I just explained to you for the same $200,000 how you can times 50,000 times 10 and make $500,000 a year. Now, you do that for 2 or 3 years, you can go buy 3 on your own in a 3-year period that you now own outright because you just made $1.5 million. And so maybe you're not quite that aggressive. You don't save it all. You get my point. If you leverage lease arbitrage, you do it in the right markets with the right properties and the right amenities that make you stick out, then you can crush it in lease arb. And you can generate a lot of cash flow that long-term will lead you to owning the property. So that's my suggestion on how to do it. Take it, leave it, kick it to the curb. But that's
it's very interesting. And when you talk about returns being better than other asset classes, are we talking cash on cash or internal rate on return? And just for context of where my question is coming from, in commercial real estate, it seems like you have more of an ability to force your appreciation, right? With increases in rent and revenue and decreases in costs and trying to increase that NOI, and financial institutions will value your asset based on those numbers, based on cap rates, and therefore you have, it seems like, more clarity or control in a way of, okay, if you make these changes, the place will be worth more by virtue of having executed those changes, right? Which is where a lot of, let's say, commercial real estate investors will argue that as much as short-term rentals might give more from a cash on cash perspective, that when you factor in the speed at which they can force their appreciation, that it ends up being a better return, appreciation considered. What are your thoughts on that?
So there's always going to be two sides to every argument. And you're always going to have people that are passionate about commercial real estate that are not as passionate about vacation rentals. Coming from a family that owns them both, my perspective is cash is king. Cash is always king. Cash allows you to go buy additional properties. Cash allows you to, have a better lifestyle at the end of the day. And so I think that the same argument could be made against short-term vacation rentals as an asset class, because every one of those lease arbitrage deals that I do, I got a purchase option on the property. Why would I go generate, $50,000 a year? That is, if you look at the $200,000 that you were going to buy that property for, it's a 25%, internal rate of return, cash on, and so that's pre-tax. So it's higher if you go post-tax, the property, right? Doesn't apply if you're lease urban. But if that property owner that has a $500,000 property now is trying to sell the property and he's showing, that it is a commercial real estate type asset, it has your cash flow in it, the property is going to be worth more, right? To be in line with a normal real estate investment, it's going to have a cap rate that's much higher by let's say 2 to 3 times what an equivalent commercial real estate asset would generate. And so for that reason, do I do both? Yes. I already told you my family's in both. So, I'm looking at the next phase of a strip mall right now that we own in Salt Lake City, Utah. And we own about an acre that's undeveloped. It's next to an existing strip mall. We're going to expand it. And I'm doing that. And at the same time, am I also looking at my next vacation rental purchase in Maui, my next vacation rental purchase that's more of a ranch lifestyle property in Arizona in Wickenburg? Yes. So as you could tell by my area out here, I'm an absolute cowboy. My kids are rodeo kids. And at the end of the day, I want the lifestyle where I spend more and more time with my kids chasing their rodeo dreams than I do, doing this. And so
That's interesting. Yeah, no, that's super interesting. And yeah, that's exactly why I was curious to hear your thoughts, given your background and the fact that, yeah, you and your family have both, right? Well, you have, the vacation rental side, and you and your family are involved in the commercial side. Okay, now I want to conclude with the following, which is more from a macro perspective, how you see this industry, as far as, there's been a lot of talks about, the COVID boom that took place, and then, post COVID kind of normalization, um, of this sector, which made certain people kind of feel the pressure when, they had bought at peak values, as far as property values went, with, peak expectations of revenue as well, because it had come from that sort of spike of demand that took place in certain markets post COVID. So where are we at now? From a macro perspective, what are you seeing, and what do you anticipate ahead for this sector?
well, I think that the industry today is, Airbnb's numbers post the industry is being up, right? But Airbnb continues to grow the inventory, and as a result, their results are up. What we are experiencing at a per property level is decreased sales due to increased supply and the same or less demand. So you've got a situation where prices were driven up. The COVID times were absolutely, bullish and frothy, and everybody was making a lot of money, and that created a lot of people coming into the sector, and so macroeconomically, I'm excited about the next period of time, because I think that our economy is going to get much better over the next 4 years. And I think that the regulatory environment is going to get better from, the perspective of entrepreneurism, mergers and acquisitions, capitalism, raising capital. The regulatory environment is going to shift substantially. I think all that drives a good economy. And I'm excited about what is to come. I do believe that we're in a downturn right now that's fairly substantial. We've seen it in our per property returns. And what happens is during those periods of time, we're trying to keep everyone calm and keep homeowners calm. And yet at the same time, they see their revenue going down in their properties. They don't see their bookings what they were a couple of years ago. And so they look to jump ship and go to a new property management company, and then they experience the same results with lesser services, and they're back within a year. And so, I think that people right now need to be patient. I think that, we will see the economy, the macro level economy rebound, and reality is people's debt is as high as it's ever been right now. And inflation has driven pricing to the point where they can't afford to live on what they were making. And so, I think that is kind of the macro tune today. And I'm hopeful that over the next few years that people will start to experience some of that frothy time again. They'll have the additional income to travel. We don't see it in the high end. We see it in the Me Too properties. And so, in the $10,000, $15,000 a night properties are still booking. But the $1,000 to $3,000 a night properties over Christmas and the holidays, they're not booking. And that's that guy that makes 200, 250,000, $300,000 a year as a couple. And, they're used to going to one of these ski resort destinations every year for the holidays. And this year they're tight. They're tight because their credit cards are up. They can't afford to buy a new Tesla, and they're holding back right now, seeing what's going to happen in this economy overall. And that's kind of where I think the economy is.
Yeah. And if the fundamental reason why, the per property revenue numbers are down comes from the fact that, to your point, inventory and supply has just been growing faster than demand has been growing, then the question is, for that trend to be turned around and per property revenues to start going back up, I don't think supply growth is going to slow down unless you tell me otherwise. I think the fact that, to your point, Airbnb keeps adding and adding and adding inventory, which is why they're seeing higher revenues and numbers, despite the per property numbers going down. So I don't think the inventory and supply growth will slow down necessarily. So then it necessarily has to come from an acceleration of demand. And if that's the case, do you see that as likely? Like, do you see that as something that can happen, like that extreme acceleration of demand, or am I missing something here in this oversimplification of the problem?
I think it's twofold. I think what you're going to see is a lot of people that bought vacation rental homes or second homes with the anticipation that they were going to, have those frothy times, are, right now, a lot of them are for sale. That's honestly what the people have said. Okay, this is harder than we thought, and therefore we're going to put the properties up for sale, and they're not selling. So what will create the demand on the buy side to get those properties into new hands that may or may not want to do vacation rentals? I think that lower interest rates are going to do that. I think you're going to see that as this economy kind of starts to shake itself out over the next 12 months. I think that at the same time, there's never a magic bullet, right? It's like business. It's just hard. You got to grind. But what I do know is that over time, the law of supply and demand will equalize and it will all work out. And so, that might take 12 to 24 months to play out, but you will see you'll see properties that aren't generating the type of revenue that people anticipated turning into long-term rentals, getting leased up for 12 to 24 months. Some of them will become lease arbitrage properties that somebody can then manage and put into a short-term vacation rental type model. Again, I don't think there's a magic bullet with it. And I think it takes a bit of time, but over time, the laws of supply and demand work. That's the way that free markets work, right?
Mm-hmm. That's very interesting. Well, listen, Jeff, we might have to do a second version, a second session here, just to get into everything else that you're involved in, from AI, and all the other projects you have going on. But this has been very, very fun, very insightful for me personally, and hopefully for the audience as well. So thank you so much for your generosity, your time, Jeff, and I really, really appreciated you taking the time to be on.
You bet, Sebastian. Thanks for having me. It's been great to be on the pod.